Jahangir Aziz, Head of Emerging Asia Economist with JP Morgan, who joins us live from Singapore. Jahangir, good morning and thank you for joining us. Jahangir, let's first talk about the core assumption for 2014. The core assumption for 2014 is that growth will make a roaring comeback. What is your take on global growth?
I think clearly we are looking at about 100 basis points higher developed market growth. And what has been problematic is that in the second half of last year, we did see developed market growth come back pretty strongly. What we did not see and where we were disappointed was that emerging markets did not respond. And if you look at consensus or look at anyone's forecast for 2014, it's almost the same. You have developed market growing very strongly and you have emerging markets pretty flat, and that includes emerging Asia. I think part of the struggle is to figure out what happens to China as far as emerging markets are concerned, because that has implications not just on emerging Asia, but on emerging countries in general because of China's role in commodity prices and the fact that emerging markets, a large number of them in fact, are commodity exporters. So clearly China is going to play a big role as to how emerging markets behave in 2014, but the developed markets look pretty good for 2014.
Jahangir, hi, morning. Let's talk about India, though. You've seen the print on the trade data as well as the IIP numbers. And the headline CPI came in yesterday at 9.8%. The core number remains at about 8% as well. What's the sense that you're getting about the macro data points? What does it all lead to in terms of the RBI action at the end of the month?
Look, if you look at the high frequency, non-inflation related data, they have softened. Both the PMI and the IP has softened. I think on the CPI front, it wasn't much of a surprise. In fact, we were surprised on the downside because we had about a 9.7. So clearly there is all the decline in vegetable prices weren't passed through into the December data. Some of that will get filtered into the January data too. So January CPI inflation should not be alarming at all. I think similarly everybody expects WPI to be show a pretty decent decline this when it comes out today. I think next month too WPI will decline again because not all the prices have been passed through. That's where I think the good news ends on inflation. The reason being that we have seen this story before. We've seen this movie unfold at least 3 times over the last 4 years. We know that there are these post-harvest effects, and we also know that by February, March, inflation is going to climb back up. And the key is what you raised. Core inflation just hasn't moved over the last 6 months from 8%. And that is the worrying sign.
So, a rate hike from the RBI at the end of the month, is that what you're hinting at?
No, not really. I think, having done what the RBI did in the last, policy review, and having set the conditions for rate hikes in the January policy meeting, there were 2 conditions that were set by the RBI. One was that they wanted to see whether food inflation would go down substantially, which it has. Not only that, it has also brought down headline. But they also wanted to see whether the core inflation momentum doesn't abate. And if you do a hair-splitting exercise, you can probably make the argument that, yeah, core inflation has probably gone down by, some decimal point. So I don't really think that the RBI is likely to do anything in January. I think it's going to wait for the January data to come out, which will take us into February. I think the problem is going to be that when the February and the March numbers come out and when inflation really comes roaring back, it perhaps just might have been a bit too late to start curbing inflation for the rest of the year.
Jahangir, whereas we keep talking about inflation, somehow everyone is obsessed with inflation. The real problem is growth, and you can really capture that there is no growth in Indian economy by the IIP data and by looking at on-ground industrial activity. Do you think the problem for 2014 is not managing interest rates or inflation? It is about getting growth back?
I would say to a large extent both the 2 of them are related. I mean, let's look at, this quarter. This quarter, most likely, this quarter meaning the March quarter, most likely is going to be even worse than the December quarter in terms of growth, because there's unlikely to be any support coming from government spending, largely because the government is hell-bent at meeting the 4.8% target. So, that rules out any kind of support. So, the first quarter can be, pretty bad, first quarter calendar. I think people are looking towards, post the political uncertainty is over after the elections, for investment to kick back in and growth to pick up. But here's the catch, that if indeed we go into the second half of the year with 8% core inflation, and then we actually have an investment spike taking place in the second half of the year, imagine what it's going to do to inflation in the second half of the year.